I'm market analyst Michael Filighera of Traders Helping Traders with the Eye of the Storm podcast, helping you make informed trading decisions for the week ahead. Good day, everybody. This is the Eye of the Storm podcast, the big picture update for Saturday, February the 11th in 2023. And today, my guest, again, joining me is Dan Ascani. And we are going to do the big picture update together today, which is really going to be wonderful for me. Hopefully, it's going to be wonderful for everybody else as well. So welcome, Dan. Thank you so much for coming in again today. And Dan and I have already spoken, so I'm just going to fill in a little bit of a gap that what we're going to talk about today is I'm going to start with what I term as my pecking order. And as most of you know, when I talk about that, I'm talking about that what sits up at the top of the pecking order are interest rates, because whatever the interest rates going up or down affects everything that we on this globe, on this planet do. Whether we're buying, whether we're lending, whether we're borrowing, everything gets affected price-wise by the interest rates, which is why it sits up at the top of that pecking order. Then coming down off of that would be the treasuries. And so we're going to be talking a great deal about the treasuries today. And Dan is going to be bringing in some extremely good information about the inverted yield curve. And we're going to get a little background on that, and we're going to get a whole bunch of information. So I'm very excited about that. And then we will also discuss the 30-year bond, the 10-year note, the 5 and the 2, so we can see what's happening within this inverted yield curve and how it's kind of moving more back to being more inverted. So, and then from there, we're going to touch on the equity markets. So I am going to initially start by just turning it over to you, Dan, and basically allow you to begin to talk about the inverted yield curve and how it come about and all that background that you want to give to that conversation, and then we'll move exactly into the individual treasuries.
Sounds good. We'll make it a conversation, and I'll give some background first. But I think one of the most important things is the huge inversion in the yield curve, and I'll explain that in a second. But, you know, looking at the credit markets is always very important because the deepest equity market corrections or crashes have been rooted in the credit market. So either there could be some horrible problem like the 2007 to 2009 equity market collapse rooted in subprime mortgages and whatever else was going on then. Right. There's a lot more than just or it could be what's going on now, like the 70s and 80s, and we have an inverted yield curve. What that means is that it's being so tight, it's jacking up short-term interest rates so far that other longer-term interest rates like the 10-year treasury yield or the 30-year treasury yield are not rising as fast. So I think, you know, if you guys read Bloomberg, there was a good graph they had. You can get these probably almost anywhere, but Bloomberg had a good graph of the inversion that's going on with the yield curve. What that means is that the 10-year yield, the 10-year treasury note yield is now under, and it has been actually for a little bit, under the 2-year yield. So the 2s, 10s are what people are watching the most in terms of what part of the yield curve is inverted. Mm-hmm. And there's more parts of the yield curve inverted than just that. But looking at what's most important in terms of the implications for a possible recession mm-hmm. is the 2-10 inversion. So the 2-year note, the short-term interest rate yields higher than longer-term interest rates. And you might think, why is that? Who would buy a 10-year then? Who would lock up their money for 10 years to get a lower rate than if you just lock up your money for 2 years? And that's a valid example. That's one reason the 2-year is so high. When that happens, and by the way, this is the highest, the most inverted yield curve in the 2s, 10s since 1981. Not coincidentally, since the last time we were battling this much inflation, which had its roots in the 70s, but the Paul Volcker years, you know, came into the 80s, and the recession we had then from 80 to 81, I think they called it a dual recession back then, right. 80 to 81, 82, 81, 82, whatever it was. It was a 2-year, very difficult period. We had an inverted yield curve, the most now the most since 1981, and it's minus 0.86%, minus 86 basis points. So basically that means the 2-year yield is 86 basis points, or 0.86 percentage points above the 10-year yield. That's an enormous inversion. Again, it's only happened 42 years ago, and that preceded a recession. The typical thinking is that a yield curve inversion precedes a recession by about 18 months, maybe 12 to 18, but conventional thinking is 18 months. It's not an exact science.
Right.
And we're starting to get close to that. I think it inverted, looking at my notes here, inverted in March 2022, I think, for the first time, right when the Fed started to raise rates significantly.
Right.
And then it kind of came uninverted, so to speak, and then back to an inversion in June, July 2022. And it's continued to invert and trend down. So if you look at a chart of the spread between 2s and 10s, the 2s, the spread going more and more negative in a consistent downtrend since, March 2022. And now it's at its most inverted point since 1981. And so what that signifies in terms of the implications for a recession is that the Fed wants things tight. The Federal Reserve Board is trying to get embedded inflation out of this economy, and it's doing so by raising interest rates at the fastest clip, I think, in history, but at least since the 80s. And it's also unwinding its quantitative easing monetary policy that it employed since the crash of 08-09, such that we're seeing short-term rates so high that instruments tied to that are becoming very costly. So, credit card interest rates, for example, are tied to the prime rate, which is tied to the Fed funds rate, or tied to what the Fed is doing, no matter what it's actually tied to. So you're seeing credit card rates go through the roof. You saw mortgage rates go from the low 3s, depending on your term of your mortgage, up to 7%, around that area.
Right.
In a very short period of time. And so that what that's saying is that we have the chance of the economy putting its brakes on and a possible recession. And I'll try to make this not too long-winded so we can make this a conversation, Michael. But, the thing is, people sometimes say, oh, come on, a yield curve inversion is predicted, something like 8 of the last 5 recessions. In other words, it's not always indicative of a recession. That could be true, but this is so deep. I think it behooves investors and money managers to not ignore this inversion. This is saying something here, and the Fed's not lightening up. And inflation, the rate of change in inflation might have cooled a little bit, but inflation not really lightening up either. It's pretty embedded in the economy. The Fed was dead wrong that it was transitory, and they're admitting that now.
Right.
So the inversion is very important to look at, and it implies possibly, along with last week's high non-farm payrolls number, where the economy added over 500,000 jobs, surprised everyone, which says the labor market is still very resilient. So it's saying that the Fed is going to remain tight for some time to come, as the Fed chairman, Jay Powell, has been trying to tell everyone, and including the market.
Right.
And that the terminal rate for the Fed funds rate and short-term yields may be higher than the market originally thought. So, the terminal rate right now, looking at the markets, the financial markets, is implied to be about 5.1% by July. That's pretty high Fed funds rate compared to the 0.25% range that it was at. So I think the bottom line, don't ignore this inverted yield curve.
Or don't ignore what the market is telling us as well. I mean, it's like you said, it's like the last Fed meeting, they'd already baked in, quote unquote, the 25 basis point hike versus a half or 3/4 of a basis point. So what I find important is right now how investors, traders, they're not necessarily seeing the significance of what's happening in the interest rates versus going into a recession. And what I'm hearing a lot of times is that the fact that there's still a great deal of money available. So, but I think that that's just the excess stimulus that's been pushed into the monetary system that still remains out there in the markets. So, and what we're witnessing there is that does not necessarily suggest, but I can understand with that much money in a recession, the Fed's got a tougher job right now, because their job is, of course, is to rebalance their sheets, rebalance the Fed, the balance sheet. And the only way that they believe that they can do that is to raise interest rates, which takes that money out of people's hands. And then,
well, they can also, sorry.
Ahead. No, you.
I said they can also drain the Fed balance sheet, because during quantitative easing, the Fed bought so many treasuries, mortgage-backed securities, and whatever. They bought it off the private sector and put it into the public sector by putting it on the Fed balance sheet, and they inflated it to something like $6 trillion on the Fed balance sheet. That means the Fed owns $6 trillion, or maybe a little less than that, worth of debt and securities. And so the Fed can drain that off slowly, which it's trying to do. It's trying to do quantitative tightening, so to speak, which is erasing quantitative easing, which means the Fed, which battled the crash of 2008, the collapse of the system, and the COVID crash, right, by supporting the bond market, buying treasuries, mortgage backs, et cetera. It supported it. Now it's trying to undo that, because all the stimulus coming out of Congress and so forth, and the reopening of the economy has made it so the Fed wants to tighten monetary conditions. Right. So as it tightens, that's actually deflation. What the Fed is doing is deflationary. It's raising interest rates. It's getting rid of its bonds or securities on its balance sheet, and that's deflationary. So the Fed's using a deflationary monetary regime to battle an inflationary economy. And the question is, can the Fed fine-tune this? I call them the wizards behind the curtain.
Right.
The wizards behind the curtain think they can control this economy, and they've actually been off a lot of times. Right. Otherwise, why do we have so many crashes? Why do we have the crash of 87, the collapse into 2002, the crash of 2008, the COVID crash? I mean, this keeps happening. Too many crashes. My view, and along with many others, I think, is that the Fed can't fine-tune it as well as they think. So this is going to be very interesting, to say the least, with all this Fed tightening and raising of interest rates, as to what it's going to do to the economy.
I agree. And I feel that their choices are raise the interest rates, rebalance the balance sheets, rebalance what they have, the inventory. But I've also found that one way that I don't think most people are even looking at or considering is the other way that they really can reduce that is to debase the currency. And that one's sitting out there. So to me, it's like, you're not going to get the currency to debase by hiking rates, because of course, you're going to pay more interest. Well, here, let me give you my dollars. And so, but if they're trying to get dollars off, then I think they debase the currency. That's one way of doing it. That's one way of taking it out of people's hands as well. Now, what I find interesting, and you mentioned, it's like, and because I agree with you that basically what we're seeing occur is not necessarily inflationary as much as that what they're creating is a deflation, a period of deflation. Now, I found it very interesting that there are certain talking heads, and there are other economists or whomever, analysts, they're using the word disinflation. And for some reason, the trading world is embracing that term, disinflation. Oh, that's a positive. So I'm like, well, because deflation is associated with, just a shrinking, right? Prices are deflating. Or disinflation, maybe that doesn't include prices deflating, and home prices deflating, and car prices deflating, and interest rates going up. So I find it very, very interesting how the narrative gets spun to keep people engaged in something they shouldn't be engaged in.
Well, the spin is coming partly from the Fed, because Jerome Powell, the chairman of the Fed, is using the word disinflation, and he's not going to use the word deflation. That's a bad word for the financial markets. Deflation is bad. You and I talked about last week, I think, about deflation, and that inflation and deflation are a monetary phenomenon. So
Yes.
people think, oh, inflation is rising prices. It is, but the rising prices are a symptom of the monetary inflation embedded in the economy. And that came from Congress with the stimulus, let's say the COVID stimulus, and also what happened during the crash of 08 to try to, quote, save the economy,
Right.
or bring it out of the ICU anyway. That comes from all that stimulus coming in, and that causes inflation. And what the Fed wants everyone to think, and the market just loves to believe this anyway, is that there's disinflation going on. That means, from Jerome Powell's standpoint, I believe, he's trying to communicate that disinflation means an easing of inflation, but not deflation. Deflation would be falling prices, a severely contracting banking system, a monetary base,
Right.
etc. Like happened in the crash of 08. That was a very dangerous situation. And I say crash of 08, it was longer than that, 07 to 09, and then the implications were longer than that, of course. The whole financial system collapsed. And it's in danger of that again, because can the Fed actually pull this off? Can the wizards behind the curtain actually pull off this soft landing? The stock market, I should say, keeps wanting to believe that this is almost over. It's almost like a kid whose parents grounded them, and they're like, okay, how long am I grounded for, and when can I come out? And am I not grounded anymore? Because then I can go buy stock again, And so they buy stock, they keep buying stock, going, we're almost there, we're almost there.
Right.
Are we there yet? Are we there yet? That kind of thing. And the Powell Fed does not want the market to think that. They want the market really to stop looking at when the Fed's going to pivot. And the Fed wants to keep tight. And so the inverted yield curve of the degree we've been talking about, as well as what's happening in the economy itself and the financial markets, are pretty suggestive that this is going to go on for a while. So it's not just that the inflation rate is disinflating. It's how long is it going to be high, and how long are interest rates going to be high? Because what's happening, based on what's going on in the non-farm payrolls number last week, over 500,000 jobs created, suggests that once the Fed even stops raising rates, they're going to stay up for a long time.
Right. Let's thank you. I think the very valuable information that we're adding here. So I hope that everybody's like either writing notes or just being clear. I think just injecting the word disinflation is just trying to keep, I hate to say it, but I'm going to say it, it's keeping a false narrative in place, because no one wants to upset the markets, because when we upset the markets, they start to go down, people freak out. And we don't want we don't want to panic. And because it can really pick up steam, it really can pick up a lot of momentum if that were to occur, i.e. what we started to see, we ended up seeing very explicitly in 2008, 2009, when it was very, very clear that the economy and the corporate and interest rates and the dollar, everything was in serious jeopardy. And then we started to see how Bear Stearns closes the door overnight. Lehman Brothers closes the doors overnight, goes out of business. Then we started seeing additional bank failures. Then we started seeing corporate failures. We started to see what happens when all that was around. Now, Jerome Powell was not the Fed chief back at that time, but he was definitely alive and well, and obviously involved in economics, in banking, et cetera, et cetera. So I can understand how the Fed does not want to produce another situation that they're going to have to really fight. And the only way that they're going to be able to fight against it is once it really starts, is to ease and re-inject, re-inflate. So make up a word called disinflation, which really is deflation, without trying to explain how we're really working on making this a softer landing than this crash scenario that ultimately likely will happen, because nobody wants to speak the truth and collectively get everybody on the same page to say, hey, we all got to go through this. Let's just make it easy on ourselves. And so, but what I want to kind of tangent over to is I want to start looking at those individual, the bonds. And because what I find extraordinary, and again, what I'm going to be bringing in now, folks, is a little bit more Elliott, a little bit more what actually has taken place thus far, and how the natural move after would be exactly what we're doing. And so because last week, so week over week, I normally will talk about and I put in where the yield ends up, where the yield ended up on Friday, February the 10th. So in the 30-year bond, the yield closed on Friday at 3.83%. And the Friday prior, so the 3rd, it was 3.63. So that, to me, we only got a 25 basis point hike. Well, folks, just in a week, we just got a 20 basis point hike all by itself. And so, and what brought that up? Well, the reigniting of this conversation about the yield curve. And what does the yield curve say? I mean, so what I'm really trying to do here together with Dan is just trying to like put the truth out there that the yield curve has been inverted for quite some time. For that to pick up again and start to get greater in its inversion should not be a surprise, because we are still in a period of inflation. So where I come from is like, if we just spell out the truth and we just kind of say, this is really what's happening behind the curtain, they're saying something different because they don't want us, the retail or the corporate investor, to get upset, to really do something silly. It's like, what? Take the market down to the level it should be at? I don't understand. So if we look at the 30-year bond, it was a 20 basis point hike. Now I'm going to go over and look at the 10-year, and the 10-year note, this is even better. So on the 3rd, which is a week ago, the close on the yield was 3, and on the 10-year note was 3.53. And if you remember, my conversation at the time was that we tend to kind of just sit around 3.5, which seems to be everybody's little comfort zone right now for the 10-year note. Now, mind you, we got down to close to 4. In fact, I think we did hit 4 before we started this little counter trend rally. So Friday on the 10th, the 10-year note finished up at 3.74. So here again, what do we have? 20 basis points, 21 actually. So coming down, because this is where it all started, folks, you got to look at the 5-year and you got to look at the 2-year. Now, the 5-year note on Friday, the 3rd of February, it ended the week at 3.67%. So you can always, now you're going to see, okay, now I get this yield curve stuff. The inversion, because right, normally the short end of the curve should be less than the long end of the curve, but it got inverted and it has remained inverted, as Dan said, for quite some time now. And there's no sign of that easing up. Even when we are going through this counter trend rally within the whole picture, the larger picture. So 5-year note on last Friday closed at 3.67. Yesterday closed at 3.93. So the 5-year note is knocking on 4%'s door. Now that was the floor that we got at the end of December. We're knocking on that door now. Now, in the 5-year note, it was higher than 4%, but in the terms of the 10-year and the 30, 4% was where we were at the end of December. And last, because this is the one that everybody was looking at, and notice the change starting way before we all recognized it. It really started last Friday. We saw the 2-year note. So from the end of January, finished out the month of January at 4.19%. Then on Friday, the 3rd of February, it closed at 4.30, so 4.30%. Yesterday, it closed at 4.5. So again, the 2-year note actually has got, if I'm looking at the chart, which I am right now, has got the largest decline going. So it looks as if if I had to put this in Elliott terms, and this is how I have discussed it prior, so I'm going to continue that discussion, that what I think is happening within the bond market is that we formed on a bond price basis 5 waves down off of the 2020 highs. So we can reverse that if we're talking yields. The 2020 lows for yield in the 30-year bond, it was 1.17. In the 10-year note, it was under 1%. Now, as a long-term market participant and a long-term analyst of interest rates in all these other markets, I found it astounding that we actually dropped. And there was the discussion, and I don't want to call it a threat, but to me, it almost seemed a threat, that interest rates would go negative. And I don't know if anybody really understands that concept, but if an interest rate goes negative, it's you're now paying the Federal Reserve or the Treasury, you're paying them to take your money. Not that you're going to get anything in return, you're paying them to hold it. And it's an astounding thing that I watched happen over in Europe. And I don't think people really get and grasp what that all entails. Nonetheless, that didn't happen. So, but if you're looking at how low these interest rates got, when we get down to the 2-year note, it was like 0.25%. 0.25%. And the 2-year note is now knocking and completed 4.5. And that's in a year plus, maybe. So if we kind of put that into perspective in terms of what can we now expect, there's 2 things that I think are going on. Granted, we yields did 5 waves down, yields did 5 waves up, bond prices did 5 waves down. We have that intervening counter trend move in both yields and in the bond price. So in bond prices, it's an ABC up. In yields, it's an ABC down. So we continue to feel that, no, I said that backwards, didn't I? In bond prices, the bond price will go up, the yield will come down. Because right now, the yields are heading back up. Yes, I'm right. So what we're seeing turn around is the possibility that these counter trend rallies, declines are done. Now, I'm not thinking that's the case. So I think that we still have the possibility that we'll kind of reach again on a rate high, bond price low, turn it around and finish this ABC move, the zigzag move. And what we're doing right now is zigzagging, as Dan said prior to us actually start to record. It's just doing a zigzag, but the internal zigzag within the larger. And so in Elliott terms, it'd be like we've got wave A of that corrective move, and this is finishing up a B wave. Now, being that it moved pretty dang fast last week, we're changing the whole narrative about seeing this yield curve kind of start to pick up steam to get further inverted. And that, I'm afraid, is a very dangerous situation for the equity markets. And it's also a very dangerous situation because in my belief, people are still, investors, traders are still trying to hold on to, oh no, the Fed's going to pivot. They've got to. Look, we've got this disinflation going on. We've got all this other stuff going on. It's got to change. They're wrong. They're not telling us really what's happening behind the curtain. It's like, yeah, they are, finally. They are telling you what's happening behind the curtain. We're choosing not to hear it. Because for some reason, we go back to a very old habit that hung out for years and years, and that is that as an investor, as a retail investor, you buy and hold. You're in it for the long term. Dan and I are both here today to tell you folks that does not necessarily have to be the case, and you don't need to sit out a whole bunch of losses in order to start making money again. So I truly believe that there's a lot of false narrative going on. But I'm going to wrap up with the bond market, because in the bond market, and this would be the 2-year note, the 5-year note, the 10-year note, and the 30-year bond, which is what I cover in my big picture update. So I believe that we could kind of come and reach a low. And I think, to be honest with you, all of the markets, like the 2-year note has reached 62% retracement, which sets it up. That's like, okay, if it stops and we start to go around, then that'll be a good thing. Then we have in the 10-year note, it has reached 50% retracement. In the 30-year bond, it has reached 0.382. So each one has reached an acceptable level for the counter trend bounce within the counter trend bounces. So we could hold here, turn it around, and we start to move back up. Now, what the market tends to hang on to is what the Fed said, disinflation, is the fact that maybe they won't raise it as much as they will. But now we're going over to what we have coming next week. And so the next thing I want to talk about with you, Dan, is how people are going from situation to situation. And instead of accepting the reality of what's happening, is like, well, I'm going to wait because we got the CPI number, and that CPI number is going to show that inflation is correcting again. And that goes right into what you just said prior to me adding the balance on the bonds, on how we hang on to that number, but how even if it shows a little bit more of a decrease in inflation, the inflation is coming down a little bit more, does not change that bigger view. So I'm going to turn it back over to you to say how we're hanging on, how the market seems to be hanging on. And the conversation is tending to go towards, we're not believing that a recession can happen. Because the Fed will just quantitative ease right out of it.
Well, I think it's a tricky situation because speaking of the equity market, the stock market, it's been almost hoping that there's going to be a soft landing, mild recession, or maybe something they could say, all right, that's over with. And so because they want the Fed to pivot. So the market's got itself between a rock and a hard place here, I think.
Yes.
Because if you look at where it is, if inflation starts to cool more and the market goes up, and when it goes up in these bear market rallies, it goes up sharply.
Yes,
so when it goes up, it's going to start expanding valuations and expanding multiples again. So there are many ways to try to value the market. Right now, I think we're at around 18 times earnings, which isn't exactly a low point for a bear market. It's actually a little bit high. And aside from that, however you value the market, if the market goes up from here and inflation starts to cool a little bit more, then it's going to be caught between a rock and a hard place, I think, because it's going to start expanding multiples, getting overvalued again, relative to the fundamentals, which are now higher interest rates. So the last time the market was at this multiple, actually even above 20, interest rates were near zero. Now you have competition. You've got money market rates. You go into your brokerage account, look at money market rates. They're at above 4% on overnight money market funds. 4.06, then those are treasuries, 4.06, 4.1, whatever, depending on the money market fund. Now there's some competition. Right. So the equity market, the stock market's going to have to have expected returns higher than just a money market fund or any fixed income investment. So the rock and hard place comes partly because if inflation starts to cool more, it's really the rate of inflation that's cooling, not necessarily inflation itself, although there's a little bit of that too. What I mean by that is inflation, I think you and I were talking about the Social Security increase was 8.7% last October, when the Social Security Administration decides what it is, depending on what CPI was the quarter before that.
Right.
So for inflation to cool from 8.7% annualized to 5 or 6%, is easier than going from 5 or 6% down to the Fed's goal of 2%.
Mm-hmm.
It's going to be much more difficult to get inflation itself down to 2%. And I don't mean the rate of change of inflation, meaning how fast is it cooling or going up. I mean what the annual rate of inflation is. So the market is going to, the rock and the hard place part comes partly in that equities go up from here because people are optimistic. They think the Fed's going to pivot, but starts to get stuck in higher valuations with declining corporate earnings. You know, the big firms just a week or so ago, Apple, Google, Amazon, they missed. And those are big mega cap companies coming in with either lower earnings or lower revenue estimates.
Apple
and so if
missed
the market
and it
gets
went
ahead
up
of itself
anyway.
here, sorry?
Apple missed and it went up anyway.
That's right. It went down initially, then they bought the heck out of it. Apple's a bellwether blue chip now. It's like you got to have it in your portfolio, you know?
Yeah.
Some people view Apple as pretty safe money, and I won't go there myself because equities have risk versus treasuries.
Right.
But a lot of people view Apple in terms of needing to have equity exposure, needing to own stock as a relatively safe bellwether. And so, you know, it came right back up. But the point is, and not to carry on too much about this same point, the market's between a rock and a hard place. The Fed is probably not going to ease off anytime soon unless there's some sort of shock again, which could happen. And it's going to have a little bit of trouble sustaining a rally sharply up from here.
I have to agree. I agree with you. So basically, we're trying to put together this picture that what's happening in the equity markets does not necessarily reflect what I call reality, and that there are times when a technical picture really trumps the reality at the moment, but how often it's not going to last. Now, one thing that Dan and I have really discussed in terms of when we move into the equity markets is that how it isn't necessarily the wave count per se. Yes, it is the wave count, but what is of a greater importance to understand is the personality and the characteristics of the wave that's in process. And so you've heard me in my big picture updates and then also on my daily updates when I talk about the personality of a third wave, the personality of a wave two, the personality of a corrective phase. And right now, what I'm counting in the equity markets is an intermediate degree B wave. So let me just put a little bit of, not necessarily Elliott speak, but a little bit Elliott speak inside what that means to me. We have the different degrees of the same wave formations. We have small degree first waves, we have small degree 5-wave rallies or declines. We have small wave ABCs, et cetera, et cetera. So the larger the degree would be the larger the move itself is going to produce. And again, just so that Elliott understands, and I break it down to, Elliott is nothing more than just a system of building blocks. Because we discussed that we have the two basic patterns, 5 waves in any direction is an impulse. It'll be followed by an ABC, which is the correction to that impulse, which are numbered waves versus a corrective waves, which are letter. We're in a much larger corrective phase. So you're going to get a whole lot of ABCs for the next several years, because that's how long if we keep moving up degrees to what we're completing. So again, relating it to that, we started this corrective phase in January of 2022. That's when the markets topped, and that began the next larger decline. And in my view, the markets, at least on the SPX and the NDX, completed supercycle degree third waves. So Dan and I were in conversation prior, and that his data goes much further than mine. And so he constructed basically from 1865. Was that correct, Dan?
Yeah, I started the long-term wave count from the end of the Civil War.
Right, 1865. So that produces a not necessarily a totally different picture, but there are slight nuances between the two, and really it's the Dow versus the S&P. So in front of all this, what I really want to kind of bring into the conversation is that right now, if we are in a B wave, and I'm going to let Dan bring, because you all heard me talk about the personalities of B wave. Now I'm going to go to someone who taught me to basically just to please discuss what the personality and characteristics of a B wave are.
Okay, first of all, for those who aren't familiar with Elliott Wave, Ralph Nelson Elliott in the 1930s postulated a principle called Elliott Wave principle, where the market moves in wave patterns, in waves, such that when it's in an impulse wave, a wave in the larger direction of the market, it moves in 5 waves, wave 1 up, then a 2 correction, wave 3 up, then a 4th wave correction, then 5th wave, and then that impulse is complete. Then it launches an A, B, C, or some form of that correction, and then launches on another impulse. So when we say 5 waves, we're talking about an impulse wave in the larger direction of the market. Mm-hmm. And we say a B wave or the lettered waves, A, B, C, and then there's an X, A, B, C, that kind of thing. That's a corrective wave against the larger impulse. So what we're talking about here is a long-term secular super cycle bull market that started at the crash of 29 and the bottom of 1932 after the crash of 29 into maybe sometime around 2022. And I say maybe because there's a couple interpretations of this, but long term we're now in a correction, a bear market, whatever you want to call it. So we've been doing ABC's lettered waves down, as Michael has been saying, since the January 3rd, 2022 peak in the S&P 500. And shorter term looks like, as Michael was saying, we're in a B wave, which is part of this corrective wave. I might add that there's 13 possible corrective waves, and that's what makes labeling corrective waves difficult after a 5-wave impulse wave completes. So we're in a B wave, which means the personality, as Michael was saying, the personality of a B wave is thin fundamentals, maybe sharp bear market, short squeeze type rallies, the kind of things we've been seeing since the 2022 peak, where we have these huge short squeezes, but the market then stops, it falls short of carrying through in that extra impulse up, and you get another drop to a new low. And, Michael, I think as you're probably expecting, I'm sure that after this corrective wave is complete again, we're dropping to a new low again, according to the preferred wave count. Right. So there's preferred wave counts and alternate wave counts, because we don't know the future. So we have a preferred wave count, meaning this is how it stacks up according to the data, but it's not an exact science. It's more of an art. So you're like, okay, the 5-wave pattern yielding to a correction. There's a couple interpretations out of 13 possible corrective patterns that we could be in, but nonetheless, it looks like we've gone far enough in this one to postulate that this rally, whether it continues more or not, is going to yield to another decline.
And you made a very good point, and when we were discussing just between the two of us, that I would like you to just bring out again, and that was how I guess it kind of comes from the fear of missing out, FOMO, but what's happening in the market, and even on a long-term basis, and what's happening with interest rates and everything else, should not have a strong effect on people putting on positions. And I'm not saying that as cleanly as you did. So if you can go back to when we were talking about that, I think that's an important thing for people to understand and to go on, is to whatever your time frame is, and if you're really timing your trading off of a monthly chart or off of a yearly chart, or however you're putting it together, it's going to have a whole different look and feel than whether you're trading on, like I do, on a daily basis. I'm coming in intraday, And so my microscope, my fine tuning is going to have a whole big difference than somebody else who's going to put on a short or a long that they know is going to carry them through what they see happening. And so you've got to be able to sit through whatever your long-term view is. You have to be able to sit through all of the bumps and grinds and everything else. So again, referring back to that, we are in a B wave. And I've heard B waves termed as sucker play. I've heard B waves termed as deceptive, and just false breakouts, like Dan was mentioning. Not necessarily saying use the word false breakout, but what I have found to also totally influence and change how the markets necessarily unfold, but and how far they could go. And that then can change your count. But normally on a long-term basis, the count's going to remain the same. The view is going to remain the same. How we then interpret that on a smaller scale, all the way down to that intraday scale, that's what's going to change. And I think a lot of that change comes from, we have moved from an open outcry system or a specialist system when we're trading stocks, where one person and everybody got together and they could pair stuff up, put up one print, et cetera, et cetera. We're now down to quantitative trading. We're now down to totally dependent on algorithmic trading, or algorithms that come in and function within our trading system, within our markets. And that in and of itself has produced a situation where in the S&P and in the NASDAQ and in treasuries as well, there basically is an expiration every single day, Monday through Friday, at least in the SPX and the ES and the NDX and the NQ. You're going to get expirations almost every day. And they're options expirations. And what I've noticed quite often is because in all of the underlying, right? So you've got not only of the indexes, but then you have all the component companies within that index. They all have options. And those options expire weekly. So every Friday is an expiration. Then we have it where you'll hear us talk about, well, the monthly expiration, a little bit bigger, because that's where a lot more positions can gather around a particular point in time. Then we have quarterly expirations. So, and then you'll hear the market commentators talk about a triple witching, a quadruple witching hour, whatever they want to call it. And that, excuse me, that just expands what is expiring. You have futures expiring, options on futures, et cetera, et cetera. That's where all that terminology comes in. But what I tend to see is that the algorithms are in control, and those are basically then some larger traders and also HFT firms. Now, if we just think about the option trading for a moment, what happens inside that week is that there are algorithms that are out and they're basically on a premium hunt. So dealers or market makers in options, we basically were not taught you buy premium. We were taught you sell premium and you hedge that. Because understanding that in an option, the option is created to go to zero. So either it's going to be in the money or it's not going to be in the money. If it doesn't get in the money, no matter what you got there, it's going to go to zero. It has no value. So premium is your friend as a trader because you want to sell it. So it adds another layer, because you've heard me speak about it, is that what we have coming into an expiration week, coming into that cycle, oftentimes we get what is called a gamma explosion, or I'm now terming Gammageddon. It's just where your position explodes on you as you're getting closer to that time frame of when this position expires. And when that happens, it forces traders, firms, everybody to make adjustments. And those adjustments are going to be made through buying and or selling the stock. More recently, what we're seeing is that they have to buy it. We saw a little bit on Friday how they had to sell it because the overall market declined. So as we shift over and we want to talk about the position of our markets in terms of Elliott and what I continue to look for, remember that I'm basically looking like the SPX and the NDX. I'm looking at the daily chart, maybe down to the hourly. When I'm in there trading, I'm down to a 2-minute and a 5-minute chart. And even sometimes the 5 minutes seems like an eternity. So I want to bring Dan back into this conversation in terms of what we are seeing on the big picture. And that even if we're bringing this down, and the reason I went into the conversation about what the B wave looks like is because Dan and I are in agreement that it looks like, oh, this is great, and we're just going to keep on going, and then suddenly it stops. Because whatever the narrative is, the reality steps back in. We started to see that last week. And part of it is because Dan mentioned, and he said, was that employment situation number that came out the week before was not a good thing. I mean, it is a good thing that people are going back to work, but in terms of our fight against inflation, and then I've actually heard people, Dan, come out and say, well, the numbers didn't show any wage inflation. And I'm like, they just went back to work. What are you all talking about? So I find that if we listen to what the talking heads are trying to pull together to show us that, no, we shouldn't go down, we should continue to go up, it's like, it's a false narrative. So that's my conversation. That's why I go there. But I'm going to turn it back over because Dan's going to start by, and if you wanted to show your chart, you go ahead, but discuss it and a little bit about what we think about the equity markets.
Right. So, and you touched a little bit, and I touched a little bit on wave personality, and that this is a corrective wave. So it's a lettered wave, a B wave within a correction, and the B wave in this sense, because the overall trend has been down since January 3rd, 2022 in the S&P 500. A B wave means a rally is counter trend within a larger downtrend. When you look at the wave personality and you're trying to decide, are we in a new bull market? Not that you even have to know that to invest, but maybe you're wondering, is the worst behind us? Are we in a new bull market? So you look at the wave personality. What that means is, if this were a true impulse wave up and the market's going way to new highs like it has in past bull markets, then we should have the personality of an impulse wave, meaning interest rates should be declining, not rising. And there should be an expansion of GDP, gross domestic product. There should be an expansion of corporate earnings or increasing corporate earnings. There should be a market that's coming from a proper valuation, and whatever that means, proper, that's a subjective term here, but
right.
Typically the S&P might bottom in the 13 PE range, plus or minus, not where it is now, 18. I think it got as low as 16. I can't remember the exact low recently, but so my point is, though, if this were an impulse wave and the worst is behind us and we're going to new highs and it's a new bull market and everything's peaches and cream, then we should have the personality behind that, declining rates, not rising rates. Instead, we have rising rates and a Fed that's saying they're going to stay high for long. They're not going to come down. And we have an inverted yield curve, meaning short-term yields are higher than long-term yields. That's backwards from what it really should be, but it happens before recessions. But we're not there yet. We're not in a recession. There's some slowing. There's some layoffs in some industries. There's almost like a quasi-rolling recession going on right now, depending on the industry. But overall, the economy is not measured or declared to be in a recession. So it really suggests that since rates aren't declining and there's those other things going on, and some that I haven't even mentioned yet, that we're in a counter trend personality. And if it's a B wave, that implies it's going to yield to new lows, or at least a sharp decline down to the previous lows, which I think were below 3,600, closer to 3,500 in the S&P cash index. So, equity market, you don't have to know long term that it's a new bull market, and that's all terminology. But you look at the personality, we're just in a what appears to be a corrective way. By the way, I don't know about you, Michael. I don't buy into the I want to say the financial medias or what's for some reason has come to stick. The definition that they say is a bear market, a 20% decline in the index. You know, a 20% decline, by the time you declare a bear market, it's maybe done declining.
Yeah, exactly.
Why would you wait for the market to decline 20% and then say, oh, it's a bear market? It's irrelevant at that point. A bear market starts the second the market peaks. January 3rd, 2022. You just don't know that that was the peak yet. In real time, honestly, you don't know. You might speculate that it was, but it's hard to pick that top. They don't ring a bell at the top, as they say.
Right.
So the market declines 20%, and then you declare a bear market. That's a little late. A bear market started when the bull market peaked, not when it's declined 20% and suddenly it became a bear market. I just had to get that in there.
I think that's great because that's what this is all about. It's a conversation between two analysts who I believe were both respected. At least I hope I am. And what we're adding to it is what I think is taking that look behind the curtain. And I think that that's important right now, because if in front of that curtain we have CNBC, Bloomberg, and other financial media, I was like, well, you got to get behind the curtain so that you can see the reality, the picture that they're trying to present. As someone told me once, that if they were to present a negative picture, even though they say they will, right, it doesn't sell airtime. Advertisers don't want to pay to advertise their product in a down market, because what most of the advertising is people smiling, people having fun. You want to buy their product. You want to spend your money. It's like, no, we're losing money, so I don't want to spend my money. So if you put that together and you accept that, then it's going to also lead you to work these things out for yourself versus believing what the media is telling you, as if the media is going to be telling you the truth. Now, I'm not saying that everybody on CNBC doesn't understand what they're doing, because I think that they do have some people who are very knowledgeable market-wise and trading-wise and are able to give opinions. Back to just talking about what I think is going on right now. I do believe in the SPX and in the NDX, because remember, on the big picture update, that's what I cover. I'm covering the cash markets. I believe that both of them are and may have completed that intermediate B wave. And if that's the case, what I look for coming off on an hourly chart is 5 waves down. I'm still unable to put that down to say, okay, B's over, we're into the C wave, because first 5 waves down would suggest that we're putting in at least a minute degree first wave out of a minor first wave, out of a larger intermediate C wave down. So, but I can't go to my hourly chart and say, oh, I got 5 waves down. Has not happened yet. So that still leaves the potential that we may see the market do another one of those skyrockets. Now, I keep talking about that Friday there was a chance they could do it, simply wrapping it around the expiration. Now, we may sit and wait, and on Tuesday, however they want to interpret, I bet you 10-1, when that number comes out, there's going to be somebody who's pushing the buy button. And if it starts something to get it all the way up there, we could race up, reach that high, finish the B wave, and the reaction then is immediate rejection. We have seen this before. We can see it again across the board. So that would be the S&P or the SPX and the NDX and their associated futures markets. And also within this expiration narrative that we have, when I went and I looked, it's starting to shift. And one thing that Dan does a lot of is like we see where they can put, the marketplace can put resting orders where larger buyers or sellers are going to start to step in. And so when I'm looking at the options like I do leading up to Friday, the options in the SPX or more in the ES, I should say, still indicated that 4,200 was a strong possibility. That shifted midday. and shifted immediately down to 4150 and then shifted again down to 4100. So as you get closer, you could see that the marketplace will change. It doesn't help you if you're sitting there waiting for 4200. So again, depending on your time frame, it's realized that we are in a finishing leg up, and it still has that potential to zip us back above 4200. And I think basis the cash, you're looking at 4220. And then we still have possibilities above that. I every time I say don't say never, I have to apply it to myself. The market could actually just blast straight up there. We've seen that done on the CPI number, right? We have to go back several months, but it was the day where that CPI number came out 0.1% better than what they were expecting. And the market jumped. The Dow jumped 1,000 points in a minute, folks. I'm not talking about the day. I'm talking about 1 minute. And I was there and I was trading it. The Dow Jones went up 1,000 points. The S&P went up over 150, and the Nasdaq went up 500, all in a minute. All in a minute. And that was more related to options expiration, squeeze, whatever you want to call it. So again, I want to make clear that while we are discussing an Elliott Wave, we are not discussing a bullish or bearish market. I won't. I'm not going to, I don't present something that this is bullish or this is bearish. I present it according to Elliott, and if the move happens to be up, you can throw bullish on there if you want. But right now, we're in a correction. We're in a long-term corrective process, and we're in a counter trend rally. And so what comes next is a C wave, and that C wave does project down to basis the future, in the S&P future, the ES, down below 3502. That's the low thus far. We're going to get down below 3502 before that C wave is complete. And again, in terms of the big picture, I think we do have the possibility that within the SPX, as well as the S&P, you've got 3,200 in the S&P in the future, 3,000, and ultimately, basis the cash, I have 2,980. And everybody thought, oh my God, no, it can't go there. It's like, why? Why wouldn't it be able to go there? It certainly can go there. And it can do the pretty lickety split. Remember, C wave, who's its closest relative? A third wave. They both can be the exact same type of a move. You've got a C wave that it can be extremely destructive and move extremely fast. And that can happen in both S&P and the NASDAQ. And those of us that trade the NASDAQ, that can happen even faster than you think. So, yes, sir.
You know, and a lot of times when that happens, you've got so-called carry trades being unwound. And that's another whole podcast in itself. But I think whether a person trades options or not, options have become very important to the entire movement of the stock market.
Yes. Yes.
And what's the reason that options volume has set record after record, and now, actually not just now, but the last couple of years, off and on exceeds the volume of the entire New York Stock Exchange.
Agreed.
So what's happening is, you know, put options, for example, are what institutions and investors can buy as an insurance. So Putin and Russia invade Ukraine, February 2022. You buy puts, right, to hedge your stock portfolio. So when you buy puts, if you're an investor or an institution, who's selling you those puts? Well, the dealers are, the market makers. They're there to make a market in what you want to buy and sell. So the options market makers, when you buy puts, have sold puts. That means they're short the puts. So you're on opposite sides of the market there, technically, but options market makers aren't going to speculate on direction. They're not here to bet on direction. They're here to provide a market.
Right.
So they hedge. You alluded to that a little bit earlier in this broadcast. And one reason I'm going into this is because the hedge book, dealer hedging, is helping move the market. Not that they're sitting there doing that on purpose, but they've got to manage their hedge books because the market is moving so much every day. Volatility is still very high, even though VIX, the volatility index, has come down from its high, I think around 33, whatever that was when it peaked a few months ago. It's come down to the 1820 level in that vicinity. So that's still, we still have volatility. The S&P is still moving 0.75% to 2% a day. So that means they have to adjust their hedge books, not just daily, but more than once a day. And so, like you were talking about, 4,200 and 4,100 and all that, when you come into any one day, they're managing their hedge books, and that's understandable. That's what they're there for. But then there's new activity coming in from traders, speculators, institutions, hedgers, whatever, the whole ball of wax, foreign traders, overnight, all that stuff. So then they have to adjust their hedge books again. So I think the point is, when you're seeing this kind of volume in the options market, whether you trade options or not, and they are risky, I'm sure people know that they're risky, so don't do that if you can't handle the risk. But whether you trade options or not, they're helping move the stock market. And so we're seeing this kind of movement, and you alluded to daily expirations in options. That's true, daily expirations. So that's helping move the market. And when you see things like the market squeezing, going straight up in a squeeze, it's not like a big conspiracy to squeeze everybody out, although, maybe that's in there a little bit, but not a conspiracy. It's a buying, it's a flow of funds, a flow of money coming into the market or out of the market, hedge book altering, stuff like that. And then those who were speculating maybe on the short side get caught and they have to cover, and that fuels the rally even more. And it turns into this big squeeze, like you were saying, Gamma-geddon, gamma being the movement, the acceleration of options, so to speak, to butcher that definition. But options can accelerate up or accelerate down. And when they do that, you see big moves in the market. So I haven't put that in Elliott context, but that's really what I wanted to get in there in terms of options helping move the market and dealer hedge books helping move the market.
Yes. And I agree. And thank you for that additional explanation, because most of the people, I believe, that are watching my updates, and again, watching our podcasts, are in the market every day. And so they're trading every day. And some of them are trying to just figure it out, because the moves are very erratic right now. And that is another typical characteristic of a B wave. These large erratic moves, whether they're tied to an expiration, which right now they are, whether they're tied to a particular stock, which in most cases they are. And for example, we saw on Friday that coming into Friday in Tesla, which these are options that expired on Tesla, they were still geared for 200. They closed above 200 Thursday into Friday. So then suddenly that narrative changed, and now the narrative was 210. I can't begin to tell you why, but whatever happened is that, and what I did say at the time to those in my trade room, if Tesla breaks 200, it's going to open the door to a lot of adjusting, and they're going to knock it all the way down. And sure enough, they did. And it ends up closing at 196, almost 197. I see on my screen, but after hours, they were stuck. You can see who was stuck because they sold it off another $2 in the aftermarket. And that's just like, okay, pair it all up, folks. Oh, we're too long. Get out. So we see all these things happening, and it truly has not a clear reflection on the economy, on what's happening in the economy, on interest rates, what's happening in interest rates, although it should. And ultimately it will. Because whatever you're doing, remember, if we go to the pecking order, interest rates, they have control over everything that we do. If we borrow money or if we're lending money. And if you're trading and you're working on margin, you're borrowing money. If you're shorting it, you're getting short interest. You're receiving money, and you'll get some short interest on that. So all of that comes into play into what happens around us. I'm actually going to wrap it up right here. Last thoughts on the equities or the market?
Last thoughts. I think we're in for more volatility and very interesting times, to say the least. I think there could be some surprises going forward, not just in the equity market, but just in general, what's happening in the world, what's happening in the economy. I don't think there's ever been a time where headline risk as high as it is now.
Amen. Yeah.
I mean, and you can go almost anywhere. You can go geopolitical,
Yes.
where Putin threatens, putting his finger on the nuclear button, or you can go to the Middle East, you can go to China, whatever's going on, North Korea, you can go geopolitical, you can go economic. There could be some surprises there. You can go unexpected things, the black swan that appears every once in a while. Headline risk is very high, and I think that's one reason volatility is not only here to stay, but the conventional index to measure volatility, the VIX index, the volatility index,
Right.
bottoms at 18 to 20 instead of where it used to go, down to what, 9 or 10 or
9,
something
exactly.
ridiculous down there.
Yes, exactly.
So, headline risk is high. Prepare yourself for surprises. There's, we all have a good roadmap. We think of what's going on, but you got to flex to the market. You got to be able to adjust. And I think that's the important thing. There's a lot of risk in investing, and the Fed's raising rates. And if you stick to the adage, don't fight the Fed, then you're actually bearish because the Fed's raising rates. And I think maybe hoping the stock market goes down and doesn't ruin its easing. Ruin its tightening.
To ruin its easing. Wow, that's what they want. No way. I will add, because you mentioned black swan, and in my own updates that I make during the week, I'm always constantly talking about surprises. And what I actually leave it at, it's like there's too many to choose from. And you mentioned several just now, Dan, and talking about what we got going on just geopolitically, within our own economy, within our own country. But here's one that's sitting out there, not getting a lot of attention, although it's mentioned often in the news now. But on February the 20th, President Joseph Biden will be in Poland, which what country Poland borders with, folks. And remember, with that Russian missile or whatever it was that kind of skipped and went over the border, I'm just saying, our president intends to go to honor something, and he's going to Poland. Who knows? Anything is capable. But for right now, I'm going to finish up this big picture update, which basically just was the bonds, but we went into greater depth in the bond market right now. So with the bonds and the whole situation there, I feel very good about that. We went into greater depth, and then covering the equity markets, just because they continue to hold everybody's attention. I will fill in the gap, and I will talk about gold and silver and the dollar tomorrow during my regular update. I want to thank Dan again, as I keep saying. But what you guys don't know is behind the curtain, he and I are basically saying we're going to continue to do this, and we're going to continue to present our views, our thoughts, and be more of speaking truth to the market by trying to get behind the curtain and present something that shows what's really happening, and how it's being presented does not necessarily reflect how it's really unfolding. And if we can pay attention to the signs that the 2-year note, the 5-year note is presenting to us, and how that's going to affect the 30-year and the 10-year, and then how that's going to affect the market, we can weave a picture together that's going to be more representative. And then hopefully people can use that to their benefit. So again, thank you, Dan. I am going to say that most folks know how they can get a hold of me, and that you can send me an email, and that would be michael@mjf1partners.com. Or on YouTube, leave me a comment. I always answer questions, and so you're always able to leave me a comment. What I also want to add now, and I'm not really speaking out of turn because it's something that he and I have agreed on. Dan and I are putting together where I'm really going to be revamping my current trade room, but we're going to be adding to that trade room. And hopefully it's going to be quite dynamic, because it will be Dan and myself. And Dan brings in a whole lot of information and a whole side to trading that I think people are going to really like. And his primary instrument is the S&P, the ES, and a lot of different types of trades that can be put on, whether they're day trades or more position type trading. But that would be an add, a strong add. And in my primary market that I trade is the NASDAQ. And as most of you know, I love to scalp. So that's kind of been my turn there. So that's coming. But in the other time, please let us know if you would have an interest. So you want to get on my mailing list or Dan's mailing list. Those of you that have an interest, you can get a hold of Dan by info@defendingyourmoney.com. And if you go there, that's an email. You just leave an email, introduce yourself, ask a question, get more information on Dan. He'll be more than happy to provide and to help you out there. One last thing. Should you be interested in coaching? You want a little bit more information? You want a little bit more on somebody showing you, teaching, rounding out some things for yourselves? Both Dan and I do offer coaching. And normally it's on a per hour basis, but send an email, let us know. And that's both Dan and myself. So Dan, again, info@defendingyourmoney.com. And me, I'm Michael at MJF1partners.com. Drop us a line, let us know. So again, thank you very much, Dan, for being here again today. We're going to do it again next Saturday. So I'm going to
Thanks for having me again, Michael.
Get this all processed and get it back out there because we want to get it published today.
It's been great. Thank you, Michael. Looking forward to it.
You're very welcome. Thank you, and good night, everybody.